And here we are, Rick.
Hey, Megan.
It's Tuesday, and it's time to get to learning here. And I've got a real live topic, and I'm going to spring it on you. You ready?
I'm ready. Let's do it.
All right. And you have your pen and paper, as always, right? Okay. Okay. So here's the situation. I have a listing here, and it's listed at let's say 650,000. And a neighbor called me and said they would like to purchase the house for their daughter. Okay. And the neighbor would pay cash to purchase the house from the daughter. However, the cash is coming from the equity in their current home that they live in. So the buyer is a neighbor who's pulling out equity from their principal place of residence to purchase their daughter a house.
Okay.
Now, you take it from here. What would be, and I think that the neighbor's house is worth about $1.05 million, and
Okay, gotcha.
the house they're buying is about $650,000.
And they want to pay cash for the house they're going to buy for the daughter.
Yep.
They use
And
the proceeds from their equity in their current residence.
Yes, and their current loan on their home is $100,000.
100,000. Okay.
So how does one do that? How do we buy a house and keep our house in this situation?
You know, all these situations are very different. There's lots of guidelines around all of these different scenarios. And what I've learned, Megan, over the years is that people get an idea in their head how they think that would work. But in practice, it doesn't really work quite that way. So that's why we want to spend time ahead of time, kind of go over what that looks like and how to structure it so that when they see your listing, they know exactly how it's going to work rather than trying to figure that out after the fact. And so the good news in your situation, they have a lot of equity. And that's great news now, but there's limits to how much equity you can take out, and depends upon what kind of loan they want to get. So they have, in this case, really two options. You can do a cash out refinance, a first mortgage, so they can pay off the underlying first and do a new first mortgage, but you're limited to 80% of the value.
So they'd be just who can buy there, yeah.
But in their case, but you cannot do a high balance loan at 80%. You got to go lower. So essentially, in this case, they're limited to about a $726,000 first mortgage, roughly, and they owe, let's say, $100,000. So they're not going to have enough equity to do the complete 100% cash offer. You take a loan amount at 726, and then they pay out that 100,000. You've got 626,000 minus closing costs. So they'd have almost the 650 or whatever that number is, but not quite. So that's one option. The other option is a line of credit. Now, lines of credit also have limitations. So typically on a line of credit, the good news is you can go up to a 90%, between 85 and 90% of value, cash out in line of credit. But there's limitations on how big that loan amount can be. So typically on a line of credit, most lenders are about $250,000 max loan amount. You might be able to go as high as $400,000. So in either of those scenarios, it would not have enough equity or could not meet the guideline to do enough cash out on a line of credit or a second mortgage. And also the second mortgage or line of credit is a higher cost loan in terms of interest rate. So I think in that scenario, if they were to do that, it's best to just do a refinance on the first mortgage. That's a lower interest rate than doing a line of credit. Right. Now, line of credit's a lower payment because it's interest only, but even so, there would not be enough. They exceed the guidelines to be able to get enough cash out to fund that 650 on a line of credit. Yeah, it sounds like a couple of limitations there.
It sounds like maybe the best option would be to have the daughter participate financially and maybe put the loan on her name so she can be an owner occupant. You get a little bit better of an interest rate than if you're an investor, and then the parents can co-sign and provide a big down payment. And
right, yeah, well, you're on the right track. You're on the right track for sure. But here's the way to structure it. You're right, but because I see if they, let's assume for the moment they had enough equity for the cash out on their house to fund 100% of that purchase price. A
Mhm.
cash out refinance is a more expensive loan than a purchase loan. So
Mhm.
what I would suggest in that scenario is just do a line of credit. I don't know,
Yeah.
maybe a couple $100,000, whatever they want to do. Because that'd be
Mhm.
interest only loan, low monthly payment for the parents. And then
Mhm.
take that, let's say it's 200,000, just as a round number. Put that $200,000 down on the house they want to buy for the daughter. And then put the daughter on that mortgage with them.
Right.
Because if the daughter is on the mortgage with them, that becomes an owner occupied purchase, which gives them the best possible interest rate. So
Mhm.
the better way to structure that would be to do a loan, to do a cash out HELOC on the house they own, and then put that money toward down payment and closing costs, and then do a lower cost first mortgage on the house they want to buy and add the daughter to it.
Mhm. Very
That's
good.
the
Well,
more cost effective way to do it.
I like that. And usually when we just had a meeting about this here in the office with the other
Mhm.
agents that I coach. And I told them, hey, when you talk to a buyer, get their information and have Rick call them because
Yeah.
all these, you've been doing this for 40 years, all the different
Mhm.
scenarios and how to put things together, and that way you can explain it so that it's easy to understand. So I appreciate
Right.
you and our chat today. And I know that the best advice is if you're thinking about buying something, don't wait until the last minute to get pre-qualified and to hash out all
Right.
this money stuff.
Yeah. We've talked about this a lot over the last couple of years we've been doing these. It's important to be very prepared when you're going to an offer. The worst experience in the world is trying to write an offer and you're trying to figure out the numbers. That
Right?
is just too much going on there. It's too
It's too
stressful,
late.
right?
Yeah. Yeah.
Yeah. So let's just do it up front. Let's get the numbers out up front. Let's put the game plan together. And that way you have a lot of clarity when you're going
Mhm.
into that offer. It's the best way.
Perfect. Well, thanks, Rick. Thanks for your time.
Thank you, Megan. Appreciate you.
I'll see you next
See you
week.
next week. All righty. See ya.
All right. Bye.